What is going on, ladies and gentlemen? We are back with another video, and in today's video I'm going to be going over supply and demand. So this is going to be the part of the boot camp. This is going to be supply and demand video. So what is supply and demand? Now, this is probably the closest strategy to ICT, like where people can be profitable off supply and demand. Now, let me say something. You can use supply and demand on stocks such as, let's say, Tesla. Like it will work to an extent, but I'm going to give you a big downside of supply and demand. One of the biggest downsides to supply and demand is instead of a support where you just draw a single line and buy off of, it's theoretically like a zone. So it's kind of like it's a zone where price tends to bounce off of multiple times, but it's also a much bigger zone than just like a 10 cent or $1 thing. So again, this is very Googleable. I don't even know if that's a word. But if I just type in supply and demand on Google, okay, and just go to stocks, and I go to the chart, a lot of these are going to be like more zones. Okay, so you can see this is more of a zone. And it looks like support. It's basically support and resistance, except it's just a zone. So you can see right here. Let me just zoom in real quick. It's where price tends to reject and bounce off of, like, and it's not one level. It's just like a zone. Okay, so hopefully that's self-explanatory. Again, we know a support line is where price bounces off of a lot. Okay, but what if we do this? What if it kind of breaks the line? Well, it may still be support. It's just more of like a zone of support. And that's what I hate about supply and demand. You are guessing, like you don't have a precise entry. When you start learning ICT and what I'm going to teach you later in the bootcamp, you're going to understand why supply and demand is just, it's so much more difficult than ICT, because when you're trading supply and demand, you are not buying off like an actual, like for example, Tesla, let's say this is 253 or 250, right? And you say, oh, this is support, I'm going to buy 250. But price literally goes back all the way down to 234 and then bounces. Meanwhile, you're probably down like $50,000 here. So how are you supposed to hold that emotionally and psychologically? It's so difficult. And that's the downside of supply and demand. And just why I don't use it, and why I don't think you should use it, and why people don't, and why you should use ICT, and what I'm going to teach you later in this boot camp, okay? But you need to understand what supply and demand is. You need to understand why it fails and why it's so bad in order to understand what I'm going to teach you. So if I just go to NQM, okay, and we just go to a spot on price, okay, I would consider this a supply zone because you can see price comes up to the zone 1, 2, 3, 4, 5 times and rejects. Now, if we go back to supply and demand stocks and look at these pictures, you remember what I said. Support can turn into resistance, and resistance can turn into support. It's the same thing for supply and demand. This is going to be supply, okay? There's supply here. Now, when we break that supply, it can become demand. Okay, so you can see in this picture right here, you see kind of a rally, and we kind of base here, kind of becomes supply, but then we break over it and then use it as a demand zone right here. Okay, so you can see how that clearly works. And when looking at supply and demand, that's not always going to happen. That's just like a picture that is all hindsight. Look at this example right here. Why might we go above this resistance, and why might we fail back? Like, why doesn't price bounce off of what was previously resistance? Well, it's all due to liquidity and ICT and what I'm going to teach you later in the boot camp. But just know that supply and demand is very hit or miss. And the thing that's bad about it is if I'm looking to take a short, because I see price coming up here, I know this is supply, I'm going to take a short. So I take a short. Oh no, I'm down $1,000. But we're still in the supply zone. But how do you think that I'm feeling emotionally? Like, oh my God, I'm down 1K. Like, it looks like the supply zone is going to break. And it's just like, oh, let's go. I'm green again. Oh, let's go. Like, do you see how it can make you emotional? It's not precise. And we need precision. If you want to be good at trading, you need precision. Okay. You need fair value gaps. You need everything I'm going to teach you later in this boot camp. Supply and demand is not going to cut it. Okay, it's not. It's just not. You're going to lose. You're going to get emotional in the supply and demand zone. It's going to stress you out. It's going to take 20 years off your life because you're going to be buying in a random zone and you don't know where we're going to reject in that zone. Same thing with a demand zone, okay? A typical demand zone would I guess some people label this as a demand zone because you can kind of see price kind of base here a little bit. So we see price base here. It's kind of consolidation. So next time we come back down, you're like, oh, I'm gonna buy where price previously based in this demand zone. Okay, so you see come in the zone, you click buy. Okay, and you're like, oh, this is great. I'm up $560. But no, oh, now I'm down 1,000. So it's not precise. And the thing is, once you start learning these concepts I teach you later in the bootcamp, you're going to be like, why would anyone use this? And to be honest, like truthfully, I don't know. It's because they don't know what I'm going to teach them. It's because they don't know what I'm going to teach. Like they don't know ICT. They don't know how, or they don't know what precision is. That's why they'd use supply and demand, because they're uneducated and they don't realize they can find more precise concepts in supply and demand. So to recap, all supply and demand is really like a big zone where we reject out of a lot of times. Like this might be a demand zone, and you can see this demand zone kind of holds here, 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 but then it finally breaks. Where would another supply zone be? Maybe that, like this would be another supply zone, and you can see the supply zone holds here, 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 and then finally breaks and then goes back below. Now, this is a foreshadow to liquidity. Why do we break above a supply zone and then go back below? Well, I told you guys in the last video, in the beginning, you have to understand how stop losses work. Where do you think people are going to put their stop losses? They're going to put their stop losses above a supply zone if they're shorting. Where are breakout traders going to long? They're going to long above a supply zone that gets broken. Right? Just like the picture shows us. This is where a breakout trader is going to long after the breakout of a base. Okay? Shorts are also going to have their stop loss above there because they see, oh, it's holding, I'm going to short, and then they put their stop loss above there. So shorts getting stopped out. Okay, and let me just explain this real quick. So if you've made it this far, some of you probably don't understand. You can short the market. Let me just do a little quick side lesson on this. We all know you can buy. Like buying is very simple to understand, but you can also take a short. So let's say I'm not in any position, and I'm not, okay? If I think price is going to go down, you can make money off that, okay? Not a lot of people, like my grandma probably doesn't even know that. I mean, she always says, if the market ever goes down, she's like, oh, you probably lost a lot of money today. No, grandma, I shorted. But just to recap, you can also take a short. So, again, all taking a short is, it's basically borrowing and buying back lower, and that's how you're making money. So if I short here, you're basically borrowing contracts. It's like taking out a loan and buying them back lower. So it's like if I bought a house, or it's like, how do I explain this? It's like if I sold my house. Let's say my house was worth $500,000, and I sold it for $500,000, and let's say the housing market goes down, and I want to buy my house now for $450,000. I can buy my house back for $450,000 And because I sold it for $500,000, I'm making $50,000 because I sold it and then bought it back for less. Shorting works the same way. So that's just a quick lesson on shorting. So if I think we're going to go down here, I could sell up here and then buy back lower. So I'm technically making money. So when we think about stop losses, a stop loss for a short would just be you buying again, because think about it. If I'm short one contract, let me go here. If I'm short one contract here, but we go up to here and I'm down 390, in order to stop out, or let's say this was my invalidation level. Let's say I thought this is a supply zone, so I put my stop loss above the supply zone. I'm basically buying back the short. So I'm just, instead of selling, I'm buying here. So I'm going to buy one contract. If I buy one, it gets me out of the position. So it's just like if I sold my house for $500,000 and the market goes up, all right, and I sell my house for $500,000, the market goes up and it's now $550,000, and I think, oh, well, I want my house again because the housing market's going up. Then I'm basically losing $50,000 when I buy back my house, because if I sold it for $500,000 but then bought it back for $550,000, I lost $50,000 in the process. So that's just kind of how that works. So that was just a little quick side mini lesson, just so you guys understand. So now that we understand that, now and how stop losses work, remember, this is a supply zone. All right. When price goes above this supply zone, you have to understand that people are going to buy the breakout because they'll be like, oh, a big resistance broke, we're going to explode. And this is what they'll think. So we're going to get buyers from that point of view. And we're also going to get buyers from people stopping out of their shorts, because in order to get out your short, you have to buy back the contract. So all that buying is going to cause price to rally. But not really. That's what the trading books teach. And that's why you see this happen, because the trading books teach, oh, we're going to go up here because we broke a big resistance. That's not what happens in the real market. In the real market, it looks like we're going to go up, and then we go all the way back down and we wreck everyone. We wreck the breakout traders. We make the shorts mad because they're like, oh my God, I knew we were going to go down, but we go up to go down. So that's kind of why understanding supply and demand is important, because if you ever see something like this and you ever see us go above a supply zone, just like in this picture right here, where we kind of get a resistance here and go above it, this in reality does not happen a lot. We'll actually go down back below that zone because people think this is going to happen, but it really doesn't. Right? How many people do you think look at this picture and fail because of this pattern? This is just not how you trade. All right. And remember, a lot of 90% of retail traders are going to long this. They're going to get wrecked. And then I'm going to be the one shorting above the supply zone. Right? I know this, doesn't that sound weird, shorting above a supply zone or shorting a pump? And it just sounds like, when I first started trading and I heard this, I was like, there's no way people do this, right? And I do it all the time now. So it's basically shorting people's stop losses and also wrecking the breakout traders. Okay. So, and if we think about how orders work, remember that little thing I do. For every buyer, there's got to be a seller. So let me just draw this to remind you what kind of goes on here behind the scenes. So this could be like a DOM right here. All right. So for every buyer, there's a seller. So this is 18,000, 8,001. So basically what's happening up here is these people who are buying right here, let's say there's buyers at, let's say there's buyers at 18,000, 18,001, 18,002. Let's say there's a bunch of orders in the book at these levels. Basically what I'm doing is when they buy there, I'm basically shorting what they buy. So I'm really sorry. This might not make sense. So thanks to them buying, they're allowing me to get in a position to the other side, because if they weren't buying there, how could I get in a position? So basically, I'm shorting and selling what they're buying. So thank you for them. Thank you for becoming. So basically, we call them our liquidity. And I'm not trying to be mean or anything, but that's just like the technical term, because they're giving me the opportunity of them buying. They're putting orders on the real market, and I'm just basically shorting those, and they're giving me the contracts. They're buying them. All right, and I think it's better to understand an example from the other side. So it's just like if I were to it's just like right here. Okay, so let's say there's people shorting this breakout. Okay, let's say people are trying to say, oh, we're gonna sell here. It looks like we broke structure to the downside. And basically them putting a sell order here, okay, or them putting a sell order here. Let's say they put a sell at 18,000, 18,001. Them selling here allows me to buy it. Okay, the only way I can buy is if people have a sell order here. So let's say they sell here, but thank you to them, I can now buy a contract here because people are selling to me here. So I'm now buying what they're selling, and then we go up and we totally wreck them. Okay, so that's kind of why they're the liquidity, and why. And really, you're probably wondering, like, if everyone knew what I was teaching right now, why would people be selling there? There's always going to be sellers here. This market runs on an algorithm, and there's always going to be sellers here. So you're always going to get filled, and you're always going to have people opposite of the trade as you. So that's just kind of how that works. So again, to recap, supply and demand is kind of when we kind of hit an area, not perfectly, but it's kind of like a general zone where we keep projecting. And this is the first thing you should know. And then demand is just the opposite, where you kind of hit an area, maybe not perfectly, but generally price will bounce out of the same area. So this would be the demand zone. This would be the supply zone. Now, let's get a little smarter here. Why do we not want to use supply and demand zones? Because the books teach this. They say, oh, if this breaks, we're going to keep going down. This is what the books teach. But we know something like this can happen. This is what's going to really happen, and this is where people get wrecked. And this is why you should understand what a demand zone is, because you're going to see this in trading and be like, oh my God, I remember Dad, you showed me this was going to happen. And this is the opposite of what the books teach. Same thing with supply zones. With supply zones, never expect this. Okay, this is too easy. Always look for something like where we go above it and then back below it. This is going to be your best case scenario. So that's just a summary on supply and demand zones and how we're going to actually use them to become smarter in the market. And I will be going over a future video that kind of, there's a pattern in ICT that will look like this kind of. Okay, so that's going to be a future bootcamp video. But that's basically what supply and demand zones are. You should understand them. And that is going to be it for this video. I'll see you guys in the next one. Peace.